We don't deal on that side of the market. Other companies do. Other companies will go and make an offer to them, and that's what they do. We only deal with a property when it's being repossessed by a bank. So it's an asset then. For us, there's no emotion in it because it's a done deal. You know, whatever's happened is very unfortunate, but someone needs to buy that asset, and that's what we deal with. Recovery. There's a change in the trend, and that's where we're at now, in my view, change in the trend. Increased lending. There is increased lending. Greater competition. There is greater competition. We've now got foreign banks coming in. The Chinese are queuing up to come into this marketplace. Gains will be moderate, and they are moderate. You know, Nationwide say 5.9%. Land Registry says 3%, whatever they say. So they are moderate, and that's good for the market. Moderate price rises, sustainable price rises. Repossessions will start to fall. Repossessions haven't been such an issue as they were in previous recessions. And the repossessions now are starting to fall. The bargains, big bargains, are more difficult to obtain. And fortunately for us as a group, we've been in this marketplace now since 2008. We have all the right connections and all the right people in the right places, which is easier for us. But if I was coming into this marketplace right now, in 2010, I think it would be more difficult to
normally the IOD in London, you'll have seen this before. It's what is market value at the moment? You know, it's quite an emotive subject. I think you'll see a lot of companies out there advertising 40% below market value, 50% below market value, etc., etc. A lot of that is actually meaningless because you've got to establish what market value is. Because if you don't establish what market value is, how do you know if you're getting a genuine discount to market value? So, you know, what these companies will have said, they'll say market value will be whatever that property sold for, you know, in 2007 at the height of the market. Whereas actually that's not the value. That's not the market value of the property now. What we're interested in is the market value of the property now in today's market. If I put this property on the market, what's it going to sell for now, today? And that's what we're looking for the discount from. That's where we're looking 20, 30%, maybe on occasions 40% from that. You know, and that's much more relevant. And how do you determine that? Really, there's only one way of doing that, I think, and that is by doing homework. You know, and this is, again, what we do as a company. We will look at all the comparables on the market. What's been selling in that area, we'll speak to the agents. You know, we'll look at all the different property price websites, you know, House Prices, Zoopla, all the usual ones. What's been selling? What's it been selling for? How recently? How easily do these things sell at the moment? What's the demand for it? And then you put all of these sources together, and then you'll come up with your market value when you've taken an average of all those sources. You know, market value isn't necessarily what a valuer tells you it is at the moment. Because one value will go in and value a property at one price, another value will go in and value at a completely different price. You know, I've seen 3, 4 valuations on the same property by 3, 4 different companies, and the difference has been huge. So, you know, sometimes the guys doing the valuation, they don't know the area. You know, they'll go in there, they haven't got a clue on that area at all. You know, so it's trying to get actually what the realistic market value is, and I think that's very, very important. Okay, so what are you looking for? What should be the criteria for you as an investor? Obviously, these haven't really changed. You know,
so you should have the handout and the booklet. Yeah? I will start. Okay, just as a bit of background, after 6th of April 2010, as I'm sure you all know, has been extensively reported in the press, the tax rates are changing. People with income over £113,000 will lose their personal allowances. 40% will seem like a low rate of tax after 6th of April this year, and the band, the 40% band, will be the biggest it's ever been, £38,000 right the way through to £150,000, the biggest band ever. Bit of a joke there, we are the biggest band ever. Bit of light relief. Thank you. So what we're telling our clients is ensure that you get money out of your companies or whatever organisations you belong to before the 5th of April. If you're big earners and you take out big dividends or bonuses, do it before 5th of April this year. Afterwards, it will be 50%. And word on the street is it will be 50% for some time. People I know who know people who know people have been speaking to Conservative MPs, and apparently what they're saying is they're not going to get shot of the 50% tax rate straight away. They may do, but they're saying they're not. Do bear in mind, and I'll come on to this, and it will have a lot of relevance for property matters, CGT is only 18% at the moment. Big issue. If you've got property investments, then you'll sell and you'll only pay 18%. Although, again, word on the street is that that is going up. So the first strategy, stamp duty. As you know, you buy an expensive property, you pay stamp duty up to anything up to 4%. We can help. We've got strategies, schemes that can reduce that to 1.5%. As you'd expect, they're highly secretive, and the people who provide these schemes don't want everyone to know about them. Otherwise, HM Revenue and Customs will probably close them down. But if you're going to buy an expensive property, commercial or residential, over about £500,000, speak to me afterwards, and I can help you reduce stamp duty. On £1 million property, 4% is £40,000, 1.5% £15,000, £25,000 saving, which is a lot of money. Furnished holiday lettings. Now, we now turn to our handbook, please. A lot of people, or some people, have operated property by way of a furnished lettings business. That's a Schedule D business. You've got a lot of advantages in the past.
You as investors, if we get it wrong. The key points I'm going to look to cover today for you are firstly managing the legal hurdles. What do we need to do to make sure that the legal hurdles are dealt with? The potential pitfalls for you as investors, what you need to be prepared for, what things that you need to have in place yourselves, the implications to you if completion is delayed through the fact that you're not able to complete on the date that's been given, the key sources of distressed property and what the legal implications are in relation to that for you, and the advantages to you of working with a specialist independent team. A little like you wouldn't go to your GP necessarily for surgery of some sort, you need to be going to a specialist lawyer when you're dealing with distressed assets and distressed property. Caveat emptor, with my house going quickly down the hill there. This is the mantra for solicitors dealing with residential conveyancing. Ultimately, it is for the buyer to make their inquiries and the buyer to satisfy themselves in relation to that property. The seller is not under any obligation other than to notify you of any latent defects or restrictions in relation to that property. Other than that, if they're not aware of it, or they are, but it's nothing that would be latent as such, they're not under an obligation to say that. And if it comes to a point where you feel that the property has been in some way misdescribed or something of that sort, then the emphasis is on you to prove that. And if you haven't made the inquiries and you haven't made the searches that you needed to do, then in all reality, you're going to fail. So the legal hurdles and what we have to deal with to ensure that that is in place, that you're not going to find yourself in that